And joining us now in studio, Jack Mintz, Palmer Chair in Public Policy at the University of Calgary, and we welcome you back to Upper Canada.
Well, my pleasure to be here.
How's things going in Calgary?
Oh, pretty good, actually, except for the weather, which sometimes gets a bit cold.
Okay. You know the Conservative government wants to lower corporate tax rates to 15%. In terms of public policy, is that a good thing to do?
Absolutely.
How come?
Well, first of all, we have to remember where we came from. In the year 2000, Canada had the highest tax burden of all OECD countries on business investments. In fact, we had the highest corporate income tax rate amongst all OECD countries. Many businesses had to pay quite substantial capital taxes. And of course, there were quite significant retail sales taxes on capital purchases. And you put it all together, we really had a very high burden. And so governments, successive governments, Liberal, Conservative, they've all worked to actually reduce that tax burden. And what we're doing now is actually we're bringing Canada to the world average.
I'm going to quote you to you. This is from something you co-authored called Federal Provincial Business Tax Reforms, released last month, and here's an excerpt. The first 1.5% point reduction already is in place as of January 1st, 2011. So a further 1.5 percentage point cut is remaining. The final reduction in 2012 would reduce the federal provincial marginal effective tax rate on capital to 18.3%, and in the long run would increase Canada's capital stock by $30.6 billion and employment by about 100,000. Now, those are pretty specific numbers, Jack, and I guess the first question here is, how do you know that if you cut taxes by X, you will definitely get Y% economic growth and Z numbers of jobs created?
Well, it's actually kind of based on a lot of work that's been done in the profession over the years, not just in Canada, but also in the United States. And what people have found, and this is sort of the number that I use, because there's many factors that explain investment. But what I use is that for every 10% reduction in the cost of capital, which includes taxes, for every 10% reduction, you get 7% more employment, which is actually a fairly conservative estimate based on a number of various studies that gives a wide range, but that's kind of like the median. And when you sort of translate those numbers, you can actually look at how much capital stock will go up by over time. This is not an immediate impact. It's not going to happen in the first year. But what studies have tended to show that within 7 years, you get most of the capital adjustment.
Okay, you know what though? Jim Flaherty was in that chair a couple of weeks ago, and I asked him that same question, and even he would not be that specific with those kinds of numbers. He did say we'll have more jobs, but he really couldn't tell me how many more.
Well, it's what an economist does. Now, these are estimates, of course, and of course there's always some variation around that. But I would stand by the $100,000 job creation, assuming that it's a matter of just picking up people who are not currently working. Of course, you may not get that many jobs to the extent that people are already working, but what it does mean is that wages are going to be bid up and that workers are going to be better off. That's really the main point.
You know, of course, that the Liberal Party of Canada argues that corporations are doing very well, thank you very much. They are sitting on a lot of cash right now. They don't need this further reduction in their corporate tax rates, and they'd like to knock the rates back up to 18%. Again, from a public policy point of view, what do you think that would do?
Well, there's two impacts that are negative. One is that it will deter investment. In fact, it'll have a very bad signaling impact on the business community, because these tax changes have been legislated and businesses have already made their plans based on them. So this is really taking back something that was already there, and so that will have a negative impact. The other issue is that this is actually going to hurt the government, not help the government. Because one of the most important things that has happened over the past number of years has been the growth of multinational corporations. And they can easily shift profits around the world through financial transactions, transfer pricing. They don't have to move a person, they don't have to move a machine, but profits move very easily. And once you take into account this profit shifting, actually the cost of revenue rate reductions, the revenue cost to government is actually pretty minor. And when you actually look at the corporate tax revenues that are being raised by the Canadian government, governments over the past 10 decades, despite bringing the corporate income tax rate down from 43 to what will be 26%, there's been virtually no change in corporate tax collections.
But if we look at the federal rate, are you telling me that, and listen, you know this stuff better than I do, so I'm asking, companies will leave here, they'll move their businesses elsewhere, they'll move their profits elsewhere if corporate taxes move from 15 to 18%?
The point is they don't move their businesses. They don't necessarily move people. What they do is they move debt, or they move leasing. arrangements, or they make insurance changes, the way they do things. You can shift profits all over the world very easily through these financial transactions. It's not a matter of changing business. It's not a matter of moving people. It's a matter of moving profits. And that's really what many economic studies have shown in the past number of years, is that when you reduce the corporate tax rate, let's say by a point, you actually can increase the corporate tax base by about 2.5%. And that's numbers for Canada.
Okay, but if you look at the OECD, we're apparently above average when it comes to corporate tax rates compared to other Western nations. But a lot of the countries on that list are places like Ireland and Estonia and Iceland. I mean, we're really not, are we trying to be in the corporate tax race to the bottom against those folks?
No, absolutely not, right. And that's not the point. I mean, if you look at Canada, if you look at around the world today, take a look at the emerging countries. This is where a lot of investment is now going. This is where a lot of competition is now coming from. In fact, they're at pretty well the international standard of around a 25–26% corporate income tax rate. Their effective tax rate on capital, the marginal effective tax rate that you mentioned, is close to 19–20%. So the main point is that we're just going to be within that ballpark.
How much will the Treasury forego by cutting corporate taxes to 15%?
Well, that's actually an interesting question, because this $6 billion number that's been bandied about is total fiction.
Well, the Liberals use it, and I think the Canadian manufacturers and exporters use it as well.
Well, I'm surprised they would, because actually Department of Finance has already clarified that in the House of Commons hearing, that actually the cost, assuming no behavioral change and no change in profits, is $4.5 billion. In fact, I've done my own numbers, and I've come really close to the Department of Finance estimates of when you're lowering the general corporate rate by 3 points, it would cost $4.5 billion, assuming no behavioral change. Okay. Now, once you take into account profit shifting, as I argue, then you actually reduce the loss by almost a half.
In which case, it's closer to 3 or 2.5 as opposed to 6?
Closer to 2.
Okay. Even having said that, we could use $2 billion right now, couldn't we? To lower deficits, to pay for programs that need paying for?
Well, by the way, one of the things I did not take into account, of course, in talking about this, of course, is the dynamic effect of increasing more jobs, increasing more investment, and that actually will generate more personal taxes and sales taxes. So when you start getting down, and also the provinces get more money because the corporate tax base expands, and they're going to pick up more revenue.
Are you saying it's going to be revenue neutral?
Yes, almost.
Really?
Yes.
Cutting corporate taxes to 15% federal rate will actually be revenue neutral.
It'll be almost revenue neutral.
Over what
and
period of
in fact,
time?
I'll be publishing that fairly soon.
And you're going to be publishing that soon, so thank you for scooping it here. I want to talk about Arthur Laffer. Mm-hmm. When's the last time we talked about the Laffer curve? Let's bring this up, shall we, Michael? You remember when Ronald Reagan was president. They just celebrated his 100th birthday not too long ago. The Laffer curve, developed by economist Arthur Laffer, illustrates, or it's supposed to anyway, that if the government charges 0% in taxes, they'll of course get zero revenues. But if it charges 100% in taxes, they'll also get zero revenues, because nobody's going to work and corporations will leave and no one will pay any taxes. So my question for you is, look at that graph and tell me where the sweet spot is.
Well, actually, it's interesting you mentioned that, because I've actually done work in that. And in fact, I have colleagues in the United States and in other countries that have done it. And in fact, our numbers come out kind of consistently now. What people have found is that the corporate income tax rate, just the rate, not all corporate taxes, but the rate itself, is that when you increase the rate, you lose revenue when your corporate rate is above 27%, or roughly around that range. That's the number I got on looking at past 10 years. There's actually a published paper that got a higher rate, but they looked at an earlier period.
So just so I'm clear, once you're at 27%, every bit you go over that, you start to lose revenue.
Right, and we're at 29 right now.
And we're 29. And you lose revenue because what? People go into the black market, or they take their business elsewhere, or whatever. Right. That kind of thing. Do you subscribe to the Laffer curve?
Not normally. I don't think it's true for personal income taxes, for example, unless you go to really high rates. And it only applies, I think, in very special cases. And I think in the case of the corporate income tax rate, there is a Laffer curve effect. And it really does show up in a lot of the studies.
Okay. Let's talk about, we've talked about corporate taxes, let's talk about what next. If you wanted to redesign the tax system in order to make us more competitive, in order to make our economy more accountable, transparent, make a fairer economy, a more just economy, what would be the next major tax initiative you'd want to take?
Well, you know, it's interesting. I've also looked at increasing taxes in some areas. And, you know, for example, I argued for moving towards more carbon taxation in Canada.
That was a
by
real vote-getter
expanding
last time.
And that's right. Unfortunately, one of the parties did listen to me on that and lost the election as a result.
But you think it's still the right policy?
I still think it's the right policy to take the federal fuel excise tax and broaden it into a carbon tax. I think just as what BC has done with its you know, with the introduction of its carbon tax. I think there are areas that we need to focus on. In my view, the thing to do in Canada, given the demographic problems and the stresses on productivity, is that we have to reduce taxes on investment savings. I think we've done a lot on the investment side. I think we need to look more at the saving side. But at the same time, the movement or greater reliance on consumption taxes is exactly the right thing to do.
Can you give me a for instance, if you want to reduce taxes on the savings side? So what would you do?
Well, for example, I would continually expand tax-free saving account limits.
What's 5,000 now?
5,000 now. I think actually that's
You'd
been
go
a very
higher.
good policy. I would also look at potentially maybe providing some help for people to save for certain needs, such as their medical needs, which I think is going to become more important in the future.
The conventional wisdom is it's better, it's fair, it's more progressive to cut income taxes and hike consumption taxes. Should we have a hike in the GST in this country?
Actually, I think...
Or I guess the HST as it's now called.
Well, actually, I think it's actually very valuable, I think, for the provinces to raise their HST. And in fact, I've actually argued that for Alberta, that they should bring in an 8% HST and cut their personal and corporate income taxes by half.
Why do you always recommend policies that are political suicide?
Well, I don't know. It's quite interesting.
No, it's
but
true.
I did get people talking about it.
I mean, the carbon tax was political suicide for Stéphane Dion.
Right.
If you tried to bring in a sales tax in Alberta, you know, you couldn't survive. They'd run you out of the province.
You know, it's very interesting. I think if you just bring in a sales tax, people would be totally opposed to it. But when you start coupling it with let's make major changes to other taxes, I think you get a different story. And in fact, my discussion about moving to an HST in Alberta really sparked a lot of discussion in Alberta.
I'll bet it did.
Including a poll.
What did it say?
The poll asked, are people in favor of bringing in a sales tax? And of course, 80% said no.
Only 80?
Which is what you'd expect, right?
I'd expect 90.
But if you asked the question differently and said, would you be in favor of bringing in an HST if you cut your personal tax by over a half? I think that would be an interesting question to ask.
So that question has not been surveyed?
No, it hasn't.
That's a good question for a pollster. That would be interesting. We know nothing's going to happen on this front in Ontario in the next year because it's election season. But after the next Ontario election, what would be good public policy in terms of, we've got an 8% HST right now and a 5% GST, so a combined rate of 13. What do you think the economy could and should handle?
Well, I think, first of all, we have to remember Ontario's got a significant deficit. And also, they've done a good botched up job with their energy policies and the cost of those energy policies and the charges associated with that. So I think a lot of the focus there is going to need to deal with that. And I think one of the areas is, I think, if they're going to rely on more taxation, it would be through the HST. I think it would make a lot of sense. But I think there's some tax relief in the areas that they're going to have to address that goes on the other side that's going to cost them money.
Like what?
Well, for example, dealing with the energy cost situation and some of the charges that have been put on, I think is really quite a
So
significant
take the
issue.
HST off energy?
I'm not sure I would take the HST off energy as much as trying to deal with these debt charges and other things that have been added to the consumption bill.
Let me ask you one last thing. Stephen Harper won the 2006 election, I suspect in large measure, because he got out there very early and said, I'm going to cut the GST by 2 points. Was that good public policy?
Actually, at the time, I would have said no, because I think higher GST was appropriate. But I do think that there's been one significant benefit of the GST rate cut, and that is it gave room for the provinces to move towards harmonizing their sales tax with the federal GST, and in some cases raising it. If you look at Quebec, they're raising theirs 2 points. They've already done 1 point. There's going to be another point increase next year. Nova Scotia has raised their HST rate 2 points. New Brunswick should have raised their HST by 2 points instead of creating a big hole in their deficit. But they had a very sensible tax reform if they had done that.
Gotcha. Jack Mintz, always good of you to join us here at TVO. Thanks so much for visiting us.
My pleasure.